Hi everyone, thank you for being here. My name is Wan Muhammad Shafiq. Today, I'll be sharing with you about a study in the field of finance. Well, specifically on technical analysis called RSI. This research was done together with the guidance from my supervisors, which are Dr. Carmila and also Dr. Siti Masita. The title of my study is Volatility versus Strength of Trend, a duration-based analysis of RSI in Malaysian stocks. It's about taking a deeper look into RSI, which is one of the popular tools used by traders, but from a less explored angle, which is how long it actually stays in an overbought or an oversold region. Okay, it may sound technical a bit at first, but I will try to keep it as simple as possible. Relative Strength Index, or RSI, is a technical analysis tool to measure the speed and change of price movement, or some might call it as momentum. RSI is commonly used in the market to spot potential reversal, which is when something is considered as overbought or something is considered as oversold. But here's the catch. In trending market, RSI might stay in those extreme zones for a long time, giving false signal to traders who expect a reversal. So, this study focused on the duration of RSI that stays in those regions to see whether it's still reliable or whether it just reflects momentum that's likely to continue. Rather than just asking, is RSI in the overbought or an oversold region right now? We ask, how long does it stay there? That would be the main focus of this study. We also didn't just look at RSI in a specific isolation. We break it down into trend direction, which is uptrend or downtrend, trend strength, which is strong or weak, and volatility level, which is high or low volatility. That's because we believe RSI signals behave very differently depending on this context, and that's what sets these studies apart. Many past studies highlight that RSI works best in trendless or sideways market, but fails during strong trends. There are also studies stated that RSI often gives false signal, and that is one of the limitations of RSI. From there are many suggestions, like modifying RSI using volume or using the implementation of machine learning for improvement. But very few look at the actual duration of RSI that stays, how long it stays in the extreme region. And that's the gap for this study tries to fill in by offering a structured, contextual way of interpreting RSI using duration, trend strength, and the volatility together. From here, we can see the reliability of RSI signals from a different angle. For the methodology, this study was conducted using 10-year daily stock prices from 2015 to 2024 for FBM KLCI and 10 selected stocks. These 10 selected stocks were the top 5 most volatile and top 5 least volatile stocks in FBR KLCI. We classify trend using 50 or 200-day moving average crossover, or we sometimes use it as MA50 or MA200 to determine if it is uptrend or downtrend. We also measure the strength using the ADX, which is average directional index, to determine whether the trend is strong or weak. From there, we observe how long RSI stays in those extreme zones during these different conditions. So, rather than just getting a buy or sell signals, we got a sense of how persistent those signals really were. So let me walk you through how this whole analysis was done. We started by dividing the market into 3 separate categories: the FBM KLCI index, the top 5 most volatile stocks, and the top 5 least volatile stocks within that index. This gives us a mix of different behaviors to analyze. Next, we look at the trend strength, which is classified either strong or weak using ADX indicator. Then, we determine the trend direction, whether the price was in the uptrend or downtrend. These are given by the crossover between MA50 and MA200. Finally, we measured how long the RSI stayed in either overbought or oversold regions across these conditions. Just to make things clearer, we're not just asking is RSI currently in overbought region. No, we're not asking that. we're actually asking questions like, how long does RSI stays in overbought region when FBM KLCI is in strong uptrend? This allows us to see patterns that typically RSI analysis might miss. This is where we start seeing patterns. The table here summarizes the average number of days the RSI stays in overbought or oversold region, depending on whether the trend is strong or weak. We can observe that during strong trend, RSI tends to stay longer in those extreme zones, anywhere between 4 to 7 trading days. That makes sense because when momentum is strong, prices tend to keep pushing in the same direction, so RSI doesn't exit immediately. But in weak trends, it's the opposite. The price action becomes a bit uncertain or choppy, so RSI enters and exits those zones quickly, usually within 1 to 3 days. So the key takeaway here is trend strength really matters. It impacts how persistent the RSI signal is, which has major implication on how reliable RSI might be for trading decision. This slide highlights one of the more interesting findings and concerning actually. There was a situation where RSI gave opposite signals to what the price trend was actually doing. For example, in a strong uptrend, we sometimes saw the RSI dropping into oversold territory, which typically signals weakness or a downtrend. Likewise, in a strong downtrend, RSI entered overbought territory, which would usually suggest upward reversal. But that's not what happened in reality. This contradiction raised doubts about using RSI purely as a reversal signal, especially in trending market. This finding ties back to what Morrison pointed out about false signal, where indicators like RSI may give misleading cues when momentum is strong. So it tells us that context matters. If traders aren't careful, they could make the wrong move simply by reacting to RSI without checking the trend. This slide compares RSI duration across different volatility levels. The top 5 most volatile stocks versus the top 5 least volatile stocks in FBM KLCI. As you can see, high volatility stocks tend to stay longer in both overbought and oversold region, averaging about 15 days and 13 days respectively. For low volatility stocks, on the other hand, they show relatively long duration, which is around 12 to 13 days, not too far off from the high volatility group. We also include FBM-KLCI index here as a benchmark, which sits somewhere in the middle. Now, what's interesting is that the differences in duration are relatively small. This suggests that volatility alone may not be the main reason RSI remains in those extreme regions for so long. So again, we come back to the idea that trend strength more than volatility might be the driving force behind RSI persistence. Here we compare this study with a past paper by Krishna Veni et al. 2019, who analyzed RSI duration for 5 Indian banking stocks. Their results showed an average RSI stays of about 11 days in overbought and 10 days in oversold region. In contrast to our study, which focused on the Malaysian market, recorded slightly higher averages, which is around 12 to 15 days for overbought and 11 to 13 days for oversold, depending on the stock group. But the key difference lies in the methodology. This study breaks it down further using trend strength and volatility categories, providing a more structured view. Despite differences in geography and approach, the results are still quite close. And that's a good sign actually. It may suggest that RSI behavior, especially in terms of duration, could share some common patterns across different markets. This slide wraps up the key takeaways from the study. First, RSI durations are not fixed. They're clearly different depending on the trend direction and strength, which means we shouldn't treat RSI signal as one size fits all. Other technical analysis tools like ADX and MA crossover can be used to complement each other. Second, when the market is in a strong trend, whether it's going up or down, RSI tend to stay longer in extreme regions. That's because momentum is more sustained in these scenarios. Third, in weak trend, the RSI exits quickly. This is likely due to the indecisive or choppy price action where there's no strong push in one direction. Fourth, we found that volatility doesn't play a major role in explaining RSI duration. The differences were quite small across high and low volatility groups. And last but not least, the context matters. If we just look at RSI duration in isolation without classifying the trend, we might misread the signal. For example, some overbought or oversold conditions occur in the wrong trend direction, which could confuse traders actually. That's why segmenting the data, like shown in the visual on the left, gives a clearer picture than just raw duration alone. That brings me to the end of my presentation. Thank you so much for your time and attention. I really appreciate the opportunity to share this study, and I hope it gave you a fresh perspective on how RSI behaves under different trend conditions. That's all from me. Thank you very much.